Michael Matthews, CFA, is a managing partner at Financial Trust and is involved in all assets of the firm's business, including management of their proprietary investment strategies, which is one of his key interests. He currently also serves as an adjunct professor at the CFA Level 1 review program at FAU, where he teaches quantitative methods, derivatives, and portfolio management. Prior to joining the firm in 2013, he earned his Bachelor of Science in Finance and Economics from the University of Central Florida, while interning at the UCF Foundation, where he performed various supporting activities for the university endowment. And we haven't read anything negative about the endowment, and our son graduated from UCF the same year that Mike did, so we're very proud of that class. And it turned out that Pablo also went to UCF, although they did not encounter each other while they were undergraduate. So upon graduating from UCF in 2009, a memorable year for all of us, he worked in the proprietary trading industry in both New York City and South Florida. So those were great times to have behind you. So please give a warm welcome to Mike Matthews, who's been one of us and a frequent contributor at our event. Mike will lead off with his presentation.
Thanks, Phil, for the introduction. I'm excited to be here. Definitely excited to be here speaking next to Pablo. I don't know if any of you guys have had the chance to talk to him, but I know every time I talk to him at an event, I usually learn something from him or hear about some other interesting project that he's working on. So today I'm going to talk a little bit about our investment philosophy at Financial Trust. I call the talk Factor Nutrition. It'll make a little bit more sense as I go along, but one of the core facets of our investment process is factor analysis, so I found the name appropriate. So if you didn't know what we look like, this is my partner Arno Mayer. He was the founder of the firm. He's in the crowd with us, and I assume you know what I look like since I'm standing up here. The firm was founded in 1989. We're headquartered right down the road in Boca Raton, so feel free to come visit us if you have a chance. And we manage both equity and fixed income managed account strategies in both all of the passive index-based smart beta active strategies as well as tactical strategies. So if I were to describe our investment philosophy briefly, I would say that we seek exposures to well-researched, uncorrelated style factors that have been rewarded historically over time. The market factor, it's not really a style factor. However, it is definitely something that our clients' portfolios are exposed to, as you would imagine, if they have an equity portfolio. But we also seek exposure to the value, quality, and momentum styles, which I'll talk a little bit more about later. Additionally, one of the big things about factor analysis, we try to combine sources of return that are uncorrelated with each other. So as you'll see, I'm going to get back to sort of the core concept of diversification in this talk. And it's kind of crazy that if you think about factor analysis, it can get fairly complicated in terms of the mathematics involved. And I'm going to talk about it at a very high level that's very accessible in a way that we can talk to some of our advisors about the process. But really what it comes down to is more efficient diversification. So I'll get into that a little bit later. In addition to these core factor exposures that we seek exposure to, we do engage in other things to try and add alpha to our process. Trend following is one of those. It's a well-researched approach. It's different than momentum. When I'm talking about momentum here, I'm going to be talking about what's called cross-sectional momentum. Trend following is sometimes referred to as time series momentum. So if you read about it, if you want to research it, that's what you would search for. And we also do macroeconomic and some fundamental analysis at a very high level to understand the context of the environment that we're operating in. So at a very high level, what are factors and why do we use them in the first place? So this is really the roadmap of where I'm going. Talk about what are factors, why do we even use them, okay? I'm going to talk about the types of factors. I'm going to define them very briefly. And I'm also going to compare active, passive, and factor investing approaches. And I'm also going to look a little bit about at Warren Buffett's success. There was a paper recently published in the Financial Analyst Journal where they do a factor analysis to get an idea of what drove his phenomenal performance over time. Okay, so back to what are factors. Quite simply, factors are just persistent drivers of return. There are characteristics about stocks, or it doesn't have to just be stocks. I'm going to be focusing primarily on equities, but these factors generally apply to multiple asset classes. And these are characteristics that explain variations in returns. Okay, so things like the market factor, that's the one probably people are most familiar with. How sensitive is an asset to changes in the market? That's the typical one factor beta that we're all taught in our early finance classes. There are macro factors like inflation. In other words, how sensitive is a portfolio to surprises in inflation? The value factor, which basically gauges the return of cheap stocks versus expensive stocks. And you can have other risk factors like country factors or sector factors that help you gauge what risk exposures do you have in your portfolio. So an analogy that I came up with is this. I created this hypothetical momentum factor, okay, and it's certainly a play off the momentum factor, but if you think of the motorcycle as the asset or the asset return, the cow would be the factor, right? It's what's driving the return. It's what's explaining the way that motorcycle goes down the road. So if we move from a single factor to a multi-factor framework, you could think of this as, if we replace the cow with a chicken. So we have like a cow factor and we have a chicken factor. As I would imagine, the chicken's probably going to drive a little bit different than the cow. And I would hope that maybe a human, if we put a human on there, it might drive a little bit different than both those animals. And then if we combine them all together, so we have this hybrid animal of part chicken, part cow, and part human, hopefully we'll get somebody that can drive straight. Okay, and that's the concept of diversification with factors. Okay, perhaps a more common analogy is the food analogy between food and nutrients. So if you think of asset types as different types of food, like chicken, broccoli, pizza, ice cream, milk, and if you think about the nutrients like carbs, protein, your vitamin B, vitamin C, calcium, these are your factors. Okay, and just as different people have different nutrition needs, for example, they might need more iron, or maybe they're just iron deficient, or maybe they need less protein because maybe they're already getting enough in their diet. The same thing can be true about factor exposures in a portfolio. So a big part of factor analysis is not just security selection, which I'll talk about today, but a lot of it is gauging what risk exposures are there in your portfolio and what do you need to complement that portfolio with to get better diversification. Aside from that, factors are also used quite widely for performance attribution. So they're important in quite a few different contexts here. Okay, so I put up here on the side, if you were to look at a risk model, it would look a little bit different than the simplified Excel risk model output that I have there, but it gives you your exposures, how sensitive are you to these different factors. So it gives you a good lens to see how diversified is your portfolio. Just like if you were trying to go figure out what you wanted to eat, you would look at the nutrition label, right? Because if I'm eating ice cream, like I want to know, am I getting any good stuff or how much bad stuff am I getting there? Okay, so if we're trying to build a portfolio, we could think of it as trying to build a balanced diet. Okay, so if I came to you and said, hey, I have a diet for you. Okay, it's going to comprise of pizza, ice cream, and beer. I assume some people might be interested. Okay, and I would say, well, that's a well-diversified, balanced diet. Right? We have 3 different food types. If you want, we can throw some other stuff in there. Name your favorite food. We'll add it to the diet. But the problem is when we go under the hood and we look at the factor nutrients, or the nutrient factors, I should say, we're probably going to be a little high in calories, probably going to be high in carbs and fat, okay? And we're not going to get all the vitamins and minerals that we need to support a healthy diet. Same thing can be said with factors, is we really want to see how exposed are we to different factors. From a top-down framework, you can think of it as how exposed are you to factors like inflation. For most people, that's probably one of the biggest macro factors they're exposed to, because both equities, despite sometimes being mentioned as a hedge for inflation, if we get large upside surprises in inflation, both equities and bonds can really get hit. And most people are made up of stock and bond equity portfolio, particularly if you're in a stagflationary environment. So This slide's kind of important, not because it's super complicated, but because it gets to the core of what we're trying to do when we're building a portfolio with different factors. Essentially, we're trying to get more efficient diversification. And you see this diagram on the right is what happens as you add an asset and we vary the correlation. The lower the correlation, the better diversification benefits we get. So that's what we're trying to do with factors. Generally, we're seeking factors that have been rewarded over time with a premium, whether it's a risk premium or behavioral mispricing. That's what we're seeking to get exposure to, so that hopefully when one factor is underperforming, hopefully the other factor will pick up the slack. Okay? So here's an example of a factor screen. And for a lot of our models, they're purely quant driven. We rank stocks. So in each column, we'll put a factor, right? Whether it might be price to sales, it might be return on equity, things like that. And we'll rank them from best to worst, and maybe we'll take the average of those scores, right? This is just one way of conducting the factor analysis. It can also be done at the country level, right? If we're trying to rank countries, you could see we have the middle two columns. It's called a VML rank and a VAR rank. The VML stands for value momentum leaders, so it's a combination of value momentum, and the VAR rank is a volatility adjusted excess return, which is also somewhat of a momentum factor as well. And we simply rank them from highest or best to worst, and then we combine those averages into a rank. And we can see we also color coded on the heat map just for a good representation of what areas are ranking high. These are not the only ways to rank factors. A lot of people will use z-scores that incorporates the magnitude of the differences in factors as well. But I just wanted to keep it simple here. Okay, so types of factors, generally two types of factors we talk about. I'm going to spend most of the time talking about style factors. Okay, but macro factors are very helpful in building a macro asset allocation. They can also be helpful if you're running a global macro fund as well. But there are things like how sensitive is my portfolio to surprises in inflation, real economic growth, returns in certain countries. So this can give you a good idea, hopefully a better idea of how diversified you are. Within asset classes or within strategies, there are these style factors. And I've listed 5 here. If you go into the research, I think there was a paper written a while ago, it was called a factor zoo. And the truth be told, one of the challenges with factor analysis is people are always discovering factors, right? And how do we know whether these are really good factors, and how do we define good? I like to define it as something that's likely to work in the future, okay, versus just something that was spuriously mined out of a bunch of data, which is very easy to do nowadays because we have a lot of computing power. So I've narrowed down 5 factors that generally have had a lot of academic backing behind them. They've survived a lot of the academic debate over the years, and they're kind of the ones that are left over, and we use the majority of these in our investment strategies. So I'm going to define them in a moment, but I also want to address this concept of the human factor, okay? And this is not just a play on words. The human factor has always been a big part of investment management. I would argue that people have been using quant screens for a long time to narrow down their universe before they go in and do their deep fundamental analysis. That's one way to do it. It's one way that we do it for a few of our strategies. But another arguably method would be, hey, we have all these factors in different columns of our spreadsheet. What's to say that we can't actually have an analyst or a portfolio manager rank stocks on their own, and they're a separate column in the spreadsheet? Okay, not to mention all the other data that firms are probably collecting on their portfolio managers. And you could actually have the algorithm give the final say in the model. So that's just one way that maybe the quant and human factors are working together. I do apologize for these next 2 slides. I don't like to keep my slides so messy. But partly for compliance reasons, I wanted to have the definitions of the factors that I actually use in some of the research that I'm presenting. I do want to note, too, these are not the actual factor definitions that we use in our research process. The reason I chose these factors is for a few reasons. One is because I'm going to present a paper later that was written on Buffett's success, and these are the factor definitions they use, so I wanted to be consistent. Okay. Second, I wanted a longer track or a longer history. Okay, because one thing about factor analysis is these factors do go through long periods of underperformance. So to really get a good feel for whether they're performing or not, you need a large sample size. Okay, so given that a lot of these factors have been around, or we have data for them going back some to the 1920s. Others, I think my sample starts in the 1950s. It was just the longest common date for all the different factors. So just keep that in mind. I'm going to go through them pretty simply. So the market factor you're familiar with. It's just the return on evaluated market index minus the risk-free rate. So it's the excess return. The size factor is going to be the return on small stocks minus large stocks. So essentially you're going long the smallest stocks, short the biggest stocks. The value factor, we're trying to go long the cheap stocks, short the expensive stocks on some proxy of value. In this case, we're going to use book to market. Momentum, it's simply, hey, we're trying to get long the stocks that have performed the best over the past year or so, skipping the most recent month, and then short the worst performing. If you're interested in the data, I provided links here. It's widely accessible. Okay, so here are some proposed factor explanations, and one of the reasons I have this slide up is, as I mentioned, it can be very easy to just discover factors, right? I think you can come up with many just random examples of, hey, this looked like it worked for the time period, because I just found something, and then it never works again because there's no economic rationale for why that factor should work. So that's why we want to see if we have a factor that works in the data, we'd also like there to be an economic explanation for why this factor should exist and potentially persist into the future. Okay? So the first factor that I have listed is momentum. Okay, and when we talk about explanations, there are usually three camps of explanations. There's either a risk-based explanation that we use, a behavioral explanation, or a structural explanation. And truth be told, there's some debate over what explanations are actually relevant. I'm not so sure that there should be a preference. You might say, well, I prefer a behavioral explanation because it means I'm not really exposed to extra risk. Okay, but what I'm arguing in this portfolio is even if it is a different risk factor, the key is it's different. Okay, it's uncorrelated with the other risk factors. So if they act independently or somewhat independently, we can still benefit by adding them or combining them in a portfolio. Okay, so one of the things with momentum is the behavioral explanation is maybe people underreact. They're slow to update their beliefs, and that causes price to react to fundamental value too slowly. Okay, and there's the flip side of that process is maybe once something starts performing, people start jumping on the bandwagon, and that can cause an overreaction, which can actually lead to the behavioral explanation for value, is maybe some people just overreact to the fundamentals. Distressed companies get too distressed. They project out too far for those glamour companies that have high growth. They project unsustainable growth rates out into the future. Real quick before I switch to value, if you look at momentum, one of the explanations there is that maybe we're getting compensated for this tail risk, right? Because there's been a few episodes in history where momentum has just gotten crushed. Okay, it has a significant left tail to its return distribution, and it tends to be somewhat fatter, or quite a bit fatter than the normal distribution. So we call those momentum crashes, and there has been some research that's been done to help kind of counter momentum crashes, but I'm not going to cover those in this talk. Value, there's also a risk-based explanation there that maybe, hey, these are distressed companies, maybe they have a high proportion of fixed assets, and if there are changes in the economy, these companies might be slow to adapt. So maybe we're getting compensated for taking that extra risk with these companies. Quality is a little puzzling because it doesn't quite make sense. Why should we get rewarded for buying good companies that have high quality earnings like things like strong returns on assets, returns on equity, low earnings accruals? Okay, it's not really clear. It could be that investors, maybe they're just only looking at the headline earnings and they're not actually looking under the hood to see, okay, are these good quality earnings that can be repeated into the future? Okay, I've also read that some people think that, hey, maybe this high returns on capital that they're getting is a proxy for this is a company that's taking on riskier projects to get over their higher cost of capital. Okay, low volatility is an interesting one. I think surprises people because the first thing we're taught is market beta in school. So right away we're taught, okay, something is more volatile or has more systematic risk than the market. So when we look at stocks maybe that have lower volatility than average, or maybe they have lower beta, what we've seen is they actually perform more or have greater returns than their market beta would suggest. And one of the rationales for that is that if you think about people or most investors are leverage constrained. Okay, I imagine many of the people here, if they're investment advisors, don't use leverage in their portfolios, which I think is generally considered a best practice for many. Okay, so the point with the low volatility factor is essentially if somebody wants to boost their returns, right, they want a higher expected return, they can't necessarily leverage up a lower risk portfolio that might have a better risk return trade-off. So they have to look for securities that have embedded leverage. Okay, so when I say embedded leverage, it might mean things like long duration bonds, or in the factor I'm talking about, it could be high beta stocks. So essentially what we're saying is it's possible that maybe these securities are overpriced simply because there are people that are buying them for reasons that are not attached to the fundamentals. Okay, and there's also a potential behavioral explanation about the lottery ticket effect, where people seem to prefer or be attracted to securities that have even a low probability of a super extremely high payout, like the lottery, even though it might actually have a negative expected return. Okay, the last one is size, which has taken some heat in recent years, because you'll see in the next slide, it's the orange line here. It's had relatively flat performance over the last 30 or 40 years or so. There's actually been some research there recently that says once you adjust for quality, the size effect comes back. In other words, the size effect says that small companies outperform larger companies on average after adjusting for market beta. But what tends to happen is a lot of those small companies have a lot of junky type stocks. Okay, and since the quality factor seems to get rewarded, that tends to be a drag on small cap. But if you compare small cap junk stocks to large cap junk stocks, then small caps have a tendency or seemingly to outperform, or large cap junk stocks, large cap quality versus small cap quality. As long as you're comparing apples to apples, the factor shows up. So one thing that I really wanted to illustrate here is not necessarily that these things have gone up over time. And remember, these are long-short portfolios. Okay, so I did throw the market factor in there, but you don't necessarily want to use the market as your benchmark here, because most of these are dollar-neutral portfolios. The low beta portfolio is actually a beta-neutral portfolio where they leverage up the low beta side to equal it with the high beta side to get an apples-to-apples comparison. But the main thing I wanted to highlight here is there's periods of underperformance in these things. It's not hard to look at this chart and see there are some sharp drawdowns here. There are periods of 10 to 15 years. I mean, value has had kind of a flat performance over the last 10 to 15 years. These things happen, and I think one could argue that that's necessary for these things to actually persist in the future. If we had something that worked all the time, everybody would flock to it, and it would be pretty easy to say, you know, there's probably a good chance this thing's going to get arbitraged out of the market. Okay. So going forward, here's that factor performance presented in the table. I'm not going to go through this too much. You can see if you look at the third row, the Sharpe ratios. These are either pretty comparable Sharpe ratios with the market, and remember these are long-short portfolios, and they've also some even better than the market. And I highlighted the skewness coefficients, skewness and kurtosis coefficients of momentum to show, like, hey, if you look at it compared to everything else, there is this large left tail that you have to deal with in the standard momentum definition. Okay, so I mentioned the Sharpe ratio of these strategies. When you're constructing a portfolio, I mean, what are the two things we want to know? We want to know, okay, what's the risk-adjusted return of the asset? And then what is the correlation of that asset with the portfolio or set of portfolios that you're going to combine with? Because that's what determines, if you were doing an optimization, that's what determines how much of that asset actually gets into the final mix of the portfolio. So I know these are a lot of numbers. Main takeaways from this graph is this. These correlations are relatively low, most between negative 0.3 and 0.3. Okay, so it does seem these are independent sources of risk and return. Okay, if you look at the green box, which is the intersection of the market and quality, there's a correlation about negative 0.5. So quality does seem to have this defensive nature to it. Okay, the next one over is the blue box, which is the correlation between size and quality. It shows, I think it's about negative 0.5. It shows up, it speaks to what I just mentioned. It seems like there's a lot of low quality stuff in that small cap bucket. Okay, and the last one, which for my firm is arguably a little bit more important, is the red box, which shows a correlation between value and momentum. In this matrix, it shows up as negative 0.2, which you might say, okay, that's negative, but that's not high. Okay, the reason we generally combine value and momentum is they tend to be very negatively correlated. As you remember, if you take two assets with positive expected returns and negative correlations, you can get pretty good benefits from diversification from combining them, right? Well, what happens is the value factor that I use is actually the FAMA French definition. And what they do is they basically rebalance portfolios. I believe it's every June. But they use the balance sheet data for book value as of December, which is good because they want to avoid look-ahead bias. However, what they also do is they also lag the price. So it's on the same day that they record book value. And what this actually does is it actually causes the value factor to pick up some of the momentum exposure. So if you actually use current prices in the value metric, the correlation actually goes to about -0.6 or -0.7. Okay, so it's much more pronounced. Okay, this just shows rolling 5-year performance of value and momentum. Main takeaway from this plot is nothing works all the time. There's 5-year periods of underperformance in these strategies, which is, if you think about how many people evaluate the performance of their managers, they're looking at the 3-year, 5-year number. A lot of times you get mean reversion over that time frame. Okay, so this is something very important to keep in mind, especially when you're evaluating somebody that uses factor analysis in their investment process. Okay. I just want to do a quick comparison of passive investing with active and with factor investing. Okay, passive investing is simple. We put our assets in a market cap weighted market portfolio and we buy and hold. Okay, if you're an active manager, you try and get alpha from this single factor model, right? When we talk about factor investing, it expands to a multi-factor model. Okay, and this is not the only factor model you can use. I just chose a few factors and put them in. And basically what the research has found is that you can explain away a lot of this alpha that some active managers have generated simply by getting exposures to these factors. Okay, and that's not to say that just because, okay, we're labeling this alpha as beta now, that it's a bad thing. Okay, because if you don't have value exposure in your portfolio, then adding value beta can be alpha to you, okay, because it's an uncorrelated source of return. So naturally, you take one of the best investors in the world, in history, Warren Buffett, and people want to know, how did he do it? Okay, so there we go. Recently in the Financial Analyst Journal, a paper was published. It was called Buffett's Alpha, and they try to explain through a factor analysis lens, how did Warren Buffett perform or do what he did? Okay. Feel free. There's a reference there if you want to look up the article. It's a pretty good article. Nothing too complicated, but there are some good insights there. I probably don't have to highlight Buffett's performance, but in the sample they look from 1976 to 2017. So they're just evaluating Buffett when he had Berkshire. There wasn't really enough data to look at his track record before then. So arguably his track record might not look as good as maybe it actually was. Okay. But I believe his performance in excess of the T-bill rate, I think it was 18-something% versus 7.5%, and those are excess returns above the risk-free rate, with a Sharpe ratio, I believe, of about 0.76 or so versus the market's 0.49. These are great results. Okay. So Buffett's investment philosophy, I figured that was a good starting point. Some of these quotes are from the paper. Some of these I just pulled off the internet. Why don't we actually look and see what did he say that he actually did, and how does that match up with some of the factors that I've discussed here? Okay, so whether we're talking about stocks or socks, I like buying quality merchandise when it is marked down. Okay, quality is there in the description. Marked down suggests, hey, you might have some exposure to the value factor. Second quote, very similar. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So same thing, they want quality companies at a good price. Okay. Berkshire's acquisition criteria, this was taken from the 2014 annual letter. He generally looks for large companies, which their results show this actually changed over time. He actually did invest in smaller companies, and then as time went on, he became a little bit more capacity constrained. So that's the size factor, sort of the inverse of the size factor. He demonstrated consistent earnings power. The companies have demonstrated consistent earnings power. So that's quality metrics, good returns on equity, little or no debt. So that's kind of a quality factor that could also be labeled as kind of a low volatility factor, because sort of a lower leverage in the capital structure could actually lead to lower volatility in the asset price itself. Management plays simple businesses and an offering price. Essentially, they need to know the price to determine whether it's actually a good deal or not. Okay, so what they did in the paper is they looked at actually three things. They looked at Buffett's or Berkshire Hathaway's stock. So they ran a regression of Berkshire Hathaway stock versus some of these risk factors. And they also reconstructed his public portfolio from his quarterly 13F filing. So they basically assumed, hey, here's his holdings as of quarter end. They assumed that he held them to the next quarterly filing, and then I believe they actually rebalance monthly in between those quarters just to keep it at equal weights. And that's a proxy for his public holdings. And then they actually did a different procedure to back out his private holdings, which is a little bit less precise. And I've actually excluded that from the results here just for brevity. One of the things that they were actually trying to figure out was he more of a stock picker or was he a manager? So I think what they found is he actually did better on his public portfolio of holdings in terms of a Sharpe ratio versus his private holdings. So they hypothesized he was actually a better stock picker. So looking at the regression results, what we see is, so these are really 4 separate regressions. We have 2 categories, okay? The one on the left is the regressions versus Berkshire stock. The one on the right, or the 2 on the right, is Berkshire's public holdings. And we look at the single factor model first on each one, which is just versus the market. And you can see his alpha for both of those is pretty large, 14% on Berkshire, 5% or so on his public holdings, and they're both statistically significant. Once you add some of these risk factors in there, his alpha comes down. It goes down to 5% for Berkshire, which is still pretty great, even though it's hard to prove statistically. But for his public holdings, it actually eats up all of the alpha, which is interesting. So it suggests like, hey, these common risk exposures, which you'll see he has positive exposure to value, quality, and low volatility. So it simply seems he likes to buy cheap, safe, quality stocks. Okay. And he actually has a unique, so I don't mention on this slide, but he has a unique source of leverage, right? So the authors found that on average, I think based on balance sheet metrics, he was leveraged up about 1.7 to 1 on average. They also computed a metric of leverage based on the volatility of public stock holdings, the volatility of Berkshire, and they came out with about 1.4, 1.5, I believe. So the thing about, you might say, well, what explains some of the difference between his public holdings and the returns in alpha of Berkshire? I would theorize maybe it's because that unique corporate structure that he developed where he has cheap access to leverage because Berkshire was a highly rated corporate issuer, and also their cheap insurance float, which I believe made up about 35% of their liabilities on average over time, which also they estimated the average cost of that float was below the Treasury bill rate. Moving on, so what are the key takeaways from Buffett's alpha? Essentially likes to buy cheap, safe, high-quality stocks. Okay, he took advantage of unique sources of cheap leverage, which is, this is rational, right? Like, he tended to buy lower beta stocks, so in order to get higher returns, he did need to use leverage. He took advantage of that low volatility factor, even if he essentially was just trying to bring his risk back up to what the market risk was. Okay. He stuck to his principles during tough times. They give a period here, I think it was 98 to 2000. There was a time where Berkshire lost about 40% or so when the market was gaining 30% or so. And this is roughly a 70% underperformance. Okay, we're talking about one of the best investors in history. Okay, and you got to imagine, I mean, as a money manager, if we did that, we'd probably take some heat, right? And I'm sure Buffett had credibility on his side, but he also had the wherewithal to stick with his principles, which is huge, right? And he got rewarded for that. Okay. One thing that's also interesting is his Sharpe ratio of 0.79 is good. It's really good. Okay, but if you talk to some active manager, even some quants, they're looking for that strategy that has a Sharpe ratio above 1, 1 to 2. And what he kind of shows is we don't necessarily need to have extraordinary strategies to get extraordinary results. Okay, and maybe Ben Graham or Buffett said it better himself when referring to Ben Graham. So key takeaways, this does not diminish Buffett's performance at all, right? He did this, all his results are after cost. A lot of these factors that I've shown you are pre-cost, gross of fees, gross of transaction fees. The public portfolio actually is kind of apples to apples there because there's no fees included in that one since it was backed out. But still, Berkshire's performance is all net of fees. Okay, he did this before all the factor research was presented. And he also found a way to leverage up or use his unique corporate structure to get a cheap source of leverage that helped generate his returns. Okay, so lastly, I'm going to kind of move through these pretty quickly since I don't have too much time. I talked a lot about the theory of factor analysis. Okay, this is why we actually incorporate it into our process. When you go from the philosophy and the theory of factor analysis and why it works to actual implementation, there's a lot of decisions that you have to make. For example, okay, am I going to construct my portfolio to take in consideration turnover? Like you can simultaneously optimize for, factor exposure and turnover, or you could just treat turnover as a separate part of the process. We're going to leave that to the trading desk, right? Or you can actually incorporate it into factor construction. Factor selection is a big issue, whether you have leverage constraints, whether you can only trade long only, things of that matter. These are all decisions that have to be made, and they do make a difference. Okay, so just because I'm not giving them time here doesn't mean they're not important, but they do make a difference. So the question is, will these factors be arbitraged away? It's a legitimate question. Okay, if you ask me for my opinion, I would say it's reasonable to believe that maybe the factor premiums won't be as high as they were in the past, right? Because there are smart beta ETFs out there. There's active managers that are leveraging it. The research has become well known. But I also think there's reason to believe that, hey, these things don't work all the time. People are impatient. Okay, there are other explanations. Even the risk-based explanations maybe shouldn't go away because they're a price risk factor. So those are just considerations to think about when you're thinking about factor investing. Okay, so just to cap it off, if I had to summarize our investment philosophy and why we use factor investing, essentially we're trying to, or we believe that factor investing has the potential to improve risk and return through more efficient diversification. Okay, and that's it. Thank you for listening to me. I'm going to give the compliance folks a shout out here and go through my disclosures. And that's it.
Pablo is currently the owner and managing member of LVR Research, LLC, where he gets to do all the research that he wants to do with all of the quantitative factors. He started the firm after graduate school to focus on the management of separate accounts and to provide consultant and research services for institutions and individuals. He seeks to blend quantitative, fundamental, and macroeconomic analysis in the investment and research process while diligently maintaining a value-driven philosophy. Something else we all have in common, we like value, and I think we also like quality. Pablo belatedly pursued the CFA charter, but the good news was he passed level 3 this past year, and he will have his 4 years of experience at this time. So in November, he will be there to receive his CFA charter at our November Charter Awards ceremony. So Pablo is going to do his presentation, and then we will take questions from the audience. Obviously, ask questions if something isn't clear, but at the end, you get to ask the real zingers of both of them. So please give Pablo a warm welcome and his close attention.
Hello, thanks for having me. Thanks, Mike. That was really a good presentation. Thank you for the kind introduction. So, like Phil said, my whole thing is that I think passive, quantitative, full discretionary, we're all active in one way or another. Whether we choose what indexes we choose, what asset allocation we're making, it all stems from some investment decision, whether it's in your capital market assumption formations, in the factors you choose, in your factor rotation. We're all active in some way, and we all have some system, some way of making the proverbial sausage. So I just want to go through how I like to do it. There's parts that I'm just going to run through because I think they might not be that relevant. If you want to stop, just ask a question, and we'll just, get going. So the first thing is, like, the capital market assumptions would be, like expected returns and projected standard deviations, higher moments to try to determine, where you want to over-allocate or under-allocate, whether it's a factor, whether it's an asset class, a type of stock, an industry, bonds versus stocks, commodities, et cetera. I like to do hedging when it presents itself. I do so through volatility exposure, so long volatility strategies. But it's conditional on certain measures. It's not a constant exposure towards long volatility because the drag is just too high. I do have concentrated equity positions, so while I use traditional factor construction to find the stocks, I like to have concentrated positions that I can study and know, and I can sort of pinpoint what my catalyst or why I'm holding it or why I like it. So while I do use a traditional factor construction to go find, and a traditional quantitative method to try to go find what I'm trying to do, at the end of the day, it's still relatively concentrated traditional value equity portfolios that we're holding. We tend to hedge them when appropriate. And as of right now, we're not holding bonds, but given the right conditions, we would hold bonds if necessary. The final point is, as the market has run its course and as so many people have become involved and knowledgeable of all the different quantitative methods for security selection, and just in general, the amount of research that is going on, there still needs to be an outside sort of idea generation source. And for the last about year and a half, most of the very few investments that we have made have come from absolutely random idea places that tend to not fall into any of the buckets of quantitative methods or traditional screening. So for the capital market assumptions, I'm just going to run through it really quickly. The way I did it back when I first started, and I just update the same sheet now, is I collected as much curated academic data as I could from places like the Fred in St. Louis, the FEMA French Data Library, AQR, which is a quantitative hedge fund, Cliff Asness, Robert Schiller's CAPE ratio data, and aligned it all together so that I could, slice and dice it by, say, bond yields or credit spreads or GDP growth rates or CPI rates, and select by the top decile valuations in the S&P. How does high book-to-market stocks do, or how do high-quality stocks do? The problem that arises from that is that you're dealing in monthly data series, so there's not that many data points. So it's hard to say, oh, this is true statistics, because you're only dealing with a small sample of data. So what I did was they have this like bootstrapping analysis, which kind of eases the process. It's still not in like the best system, but it kind of helps with getting an idea of what the statistical look of different factors, different asset classes, and different assets look like under certain conditions. So if you were to say, what is the average return of the S&P 500? Right, it's 7%, let's say, total return of 9% over the last 100 years since 1900. Okay, but what is it when the CAPE ratio is in the top decile or the Q ratio is in the top quintile? That reduces you to maybe 3 years of observations or 10 years of observations. And to say, this is a projected or expected return given this conditional evaluation, it makes it quite difficult. But I think there's still information in it. So I have this data set, and I cut it and I dice it, and I just take a look at data conditional on different things, and interesting things come out. For the most part, what you would expect happens. Tighter credit spreads lead to bad credit returns. High valuations lead to higher drawdowns. They lead to lower returns. They lead to higher, tail events. So in general, it just is a way for me to say I want to be underallocated or overallocated. Interesting things. FEMA French have sector data, so everything from miners to utilities all the way back to 1900, I think. So you can actually do sector analysis on these things too. And it's not as revealing as one would think. I've sliced and diced them, and there's really not too much there from what I found. But for example, the other thing is monthly return data is really choppy, right? So you can't really get an idea. So what I did here is I took and I compounded monthly return data. So if you were to hold the low book to market, so the cheap FEMA French third percentile, minus the total, so the total return on the factor minus the total return on the S&P 500, if in any one of these periods you were to hold a factor for a year, and how much the outperformance over the S&P would be. And what you can see with value is that it tends to kind of like the high, so the traditional factor would be cheap stocks minus expensive stocks, right? So this is cheap stocks minus the S&P 500. And cheap stock minus expensive stocks could do well, but it's probably driven by the expensive stocks having a bad problem. So just going long value kind of tends to not do so well for long extended periods of time, as you can see here, with very good periods of time extended. And the good period of time tend to follow periods of like systematic overvaluation. So like you can see right here, if you were to buy in 1999, you did really, really well holding cheap stocks versus the S&P for a year. If it was cheap stock minus expensive, you've probably done much better. But in a world in which you can't short and you're just trying to decide whether owning cheap stocks is enough of a reason, I found it to be an interesting chart. Look at momentum, for example, tends to outperform the S&P in the same sense, which I found for the most part, Quality is similar to, this is quality from Cliff Asness quality minus junk data set. And again, it tends to have long periods of underperformance in the 80s that didn't do so well. But then post the dot-com boom, it did really well. And then post the 2007 crash, it did well. But junky stocks did amazingly coming out of 2009, as you would expect, because they were so cheap and beaten down. The other part that we get to is, he talked about momentum crashes. I'm going to skip through this, but there are some indicators that have been developed to try to determine when momentum starts getting too far out of the way and the conditions start becoming a little bit fragile. That tail risk, that left tail that you're talking about, becomes more possible. So if you were to just constantly hedge the tail or constantly hedge the left, downside risk, you're going to get crushed because the market tends to go up, put options are too expensive, and if you straight delta hedge, which means you're concerned with hedging the movement in the price, then you're going to have a big drain on the market. So we use volatility. So when vol gets really, really cheap, as it is now, and you hedge with options that are much more convex to the volatility aspect than to the stock price aspect, then the market can continue to go up, and your drain on the option isn't going to be as big because it is far to the money and it's more concerned with how your volatility jumps. And I thought that volatility had a floor, but up until February 2018, it appeared that volatility was never going to have a floor. I mean, we hit volatilities of 8%, which was unheard of, and then it crashed, right? Then we had a gigantic problem. And what seems to happen, and I'm just going to get through this really quick, is December of 2018, we had a pretty severe correction, and we had hedges on that should have been working pretty well. But volatility never came up. It just stayed. And I recently read an interview with somebody, and it appears that there's been a systematic volatility hedging, and there seems to be a barrier somewhere around 20% down in the market before a volatility event comes to play. So we do use volatility hedging when appropriate, and the main idea is to have cash to come in a bear market to be able to deploy for better opportunities, right? So we don't have to sell positions of ours that we like, that are probably beaten down, and have to sell something that's beaten down to buy something that's more beaten down, right? Like, these vol strategies should provide enough convexity, enough junk, like enough for fresh cash to buy the truly beaten down opportunities at the bottom. And the drag depends on how ratcheted up or down you are in terms of the hedging. So the screening that we do is essentially factor construction. So I do I went through all the papers, and figured out there's a bunch of hedge funds that have been publishing their work and publish exactly how they construct their value minus their value factor, their momentum factor, their quality factor. And I took theirs and I did some research and I picked parts that I liked and I picked parts that I didn't like. And I ended up with a screen that, depending on the amount of tickers that you takes up to about 250,000 data points. And it then synthesizes all those data points and it comes up with relative z-scores. So essentially it's a way of determining relative values for everything from safety to profitability to leverage to momentum. It takes data from all over the balance sheet. The main sources of it was the company's called Alpha Architect. They published a couple of books. Started with theirs, Cliff Asness Quality Minus Junk paper, and their High Minus Low. And we take the data points from FactSet. So essentially it's a big screen. It takes the data points from FactSet from balance sheet data on a yearly basis. So essentially the quality part of it is on a yearly basis. So if you were to rank by quality, it's about once a year, just about now, that you get, a change, because it's on annual reported data, so it only changes once a year. Momentum and value change day to day, month to month. The other thing we do is for each stock, we run famous French regressions, and then that tells you essentially beta, idiosyncratic skew. So more like quantitative work in terms of time series information regarding beta and exposure to some of the known factors. And then the residuals from that tell you how risky or not risky that company can be on its own, essentially. And it also gives you a measure of momentum, outside of the market. How much does this company tend to go up on its own for the last year? Again, everything is measured in standard deviations and z-scores, so we can do it all on relative terms instead of individual terms. The first thing I do is an earnings quality screen to try to weed out the worst 10% on earnings quality. These are just papers that they're based on: Campbell Financial Distress, Scale Total Accruals, Scale Net Operating Assets, and the M-score, which is similar to Allman Z-score, and it's a new version of it. Momentum, I use the 212-1, so it's this traditional momentum analysis. The total skew, which is, again, when you run a traditional famous French regression, is does the stock have more errors to the upside over the last year than to the downside? Idiosyncratic is on its stock alone. And max move is actually, it gets penalized if for the last year, one of the moves was a jump. So if a stock is up 20% in the year, but it went up 15% in 2 weeks, then that's not as good as a momentum score as a stock that went up 20% in a year in a steady fashion. And the idea is that part of the momentum, the reason momentum exists is that the market is slow to incorporate good information, and momentum is just a way that the market is incorporating information. Quality is, each one of these has about 5 or 6 scores underneath it, but essentially it's current profitability, it's operational improvement, so that's 1 year improvement in profitability, 5-year changes in profitability, so essentially long-term growth and improving operations, the stability of profitability, so how much it's moving over 5 years, and then a safety score, which essentially is the volatility of the stock, leverage, current liquidity. This doesn't look that good, I guess. But essentially, this is what it looks like. These are the top 20 on the screen right now, sorted for quality. And you can't see over here, but traditionally speaking, the z-scores are measures of standard deviation, right? So traditionally speaking, I've run this screen for years now, and 1.7 is, what is considered a far record. And this May, the top 20 companies, there's a bunch of 2.3s and 2.4s in current, in actual profitability, which is something I can't figure out, right? Because that means that there is a small amount of companies, either a lot of companies are clustered to the downside in profitability compared to these companies, or there is a small set of them that have managed to really outperform in current profitability. But it's rare and that is a driver of quality, right? Like each one of those things should be equal weighted. And in this case, all of these companies that are here, the main reason that they are in the top 20 is because of current profitability. So I went into the profitability part of it. Which one was it? And gross profit on assets seems to be like a pretty high one, but in general, it just seems that companies have become more clustered around a mean in terms of profitability, and there is real outliers becoming, showing that they're more profitable than the rest, because improvements in operations aren't coming through. And again, it's hard to see, but this is the quality screen from July 2016, and the numbers were much more along the lines of what would have expected. Companies seem to tend to be, once you're in the top 50 on my scoring in terms of quality, they tend to be in the top 50, right? So it tends to be, it's rare that a company will drop. So the main reason I like to use the quality screen is just getting to know companies, right? Like companies that you had no idea existed, and all of a sudden you see them, and they are extremely profitable, extremely safe, extremely good, and you didn't know existed, And I found a lot of them. The only problem is most of the time they're valued there is no reason to invest in them. You just put them in the, in the following list, and you keep going. For investable assets, we link quality and value scores together and try to find quality companies that are cheap. What tends to happen is that those are rare. There's always a problem. It's difficult to try to find them. This is what the momentum looks like. Again, you would expect the top of the momentum screen to be littered with, tech companies, and at the top is waste management, and Canagher's in there, right? It's not. When you actually get down to the list of what the inside of a momentum factor can look like, it's not all semiconductor stocks. Companies you had no idea would be in there end up being in there. The value screen I don't usually use because you end up with a bunch of junky companies. Seriously, literally just bad. The momentum's always terrible. The other main reason I follow momentum more than anything, and especially now, is becoming a very, very, very popular factor. You can see it. You can see if you're tracking top and bottom momentum stocks on your watch list. On a day that the stock market's up, the bottom part of momentum is getting crushed, and the top part of momentum's outperforming with no news, right? Smallish companies or medium-sized companies with no news, down 4%. And I think a lot of it has to do that they're caught in these baskets, and a lot of money is going into flows, and momentum is probably it's called a high beta factor, where if people think the market's going to go up, they're going to use momentum. So that tends to happen. But in my case, if I finally start getting into wanting to purchase a company or invest in a company, I'm not going to do it if it's in these top 20 of low momentum, right? That was high momentum. If it's anywhere in the bottom third of momentum, I'm waiting, because it's going to get crushed. I learned my lesson on that one. I was like, no, it's not going to happen. It happens. They will crush low momentum. So what ends up happening is, let's see, the oil crash in 2015, ran the screen, lots of ideas, right? Industrials were all over the place. There was all kinds of quality companies that you could buy because the market was down and the screen worked great, and there was all kinds of stuff. Couple more times like that, now you run the screen and there's stuff, but you can't, everything's expensive. It's expensive. Things are expensive out there, and just because it's high quality doesn't mean you have to buy it, So we had to start resorting to other ways of coming up with outside ideas or other things to do. So I'm now going to get through, during the oil crash, we did some work. We were trying to get companies that were like as positively correlated to just oil as possible. So try to get something that was like a long call on oil. And we came up with Equinor, which is Statoil was then, now it's Equinor, the Norwegian oil company. Part of it is, I think, because of the kroner exposure, but when you did the work, like ExxonMobil to oil is actually not that correlated, right? S&P, it's really correlated. And Equinor is like, oil is really correlated, and S&P not so correlated, especially in the tails. And it worked quite well. I mean, like, you can't see this chart again, but if you look at it indexed together, I mean, the correlation is really, really good. So it's worked quite well as an oil play. So right now, I think possibly like my sort of rolling thesis is that inflation is dead. Nobody cares about inflation, right? So we're trying to find inflation sort of type commodity royalty trust type companies. Led us to some gold miners, forestry companies. You know, we're still looking around. It's not a fully developed thesis, but you know, I think like the main thing is this idea of nobody is concerned about inflation. There's no inflation premium in the market. So try to find something that won't fall that much, but has a positive catalyst in an inflation risk. The one we did do recently is Liberty Global. And that came up, we were watching an interview with John Hampton. He's an Australian short seller, and he was talking about Verizon spectrum valuation. And essentially, you know, what the hidden asset is in Verizon spectrum valuation. And that led to what 5G is going to look like. And essentially the idea that pipes in the ground are valuable, right? Who's got the best fiber in good places? And again, this isn't quant. This just like comes out of nowhere, and like that's where we had to get to because there was not that much coming out of the screen. So we started coming around, reading 13Fs. It came up on a bunch of smart people's 13Fs, and we started looking at it. It doesn't fit. The reason like I wanted to bring it up in a quant presentation is that it literally, I don't think it fits in any single index. It doesn't follow any single factor. You won't find it, their top, you look at any company's top holders, and it's all ETF and index providers. You look at their holders, and it's people. I mean, there's a couple of mutual funds, but like old mutual funds, right? Suppliers. It's hedge funds, it's individuals, it's John Malone. But anyway, so the reason it doesn't fit in anything is that it's jurisdiction in the United States with operations in Europe. So it doesn't sort of fit, right? Like it's listed on the NASDAQ, based in the United States, operations in Europe. Already starts to mess up. Is it an international company or is it a US company? Doesn't really work. When you look at it, it looks leveraged to the hilt. Like it really looks highly leveraged. So it's not going to fit in any quality screen. It's going to be high risk. It doesn't work at all. The main reason is that they went on an acquisition spree and were literally buying up from 2012. They bought up all kinds of stuff, financed through debt. And their whole thing is that each piece of debt, and I've gone through them, right? Like you look at their capital structure and it is a mess of debts in every single European currency you can think of. And there is swaps in every single currency you can think of. Fixed for floating swaps with currency, you know? And the reason it is that they have like a policy where they link every piece of debt and every swap together to one project. So when you look at it on aggregate, it looks really over-levered. But if you put that aside for a minute and realize that those debts are tied to long-term projects, and the reason they did that is because they can borrow in Europe at such a low rate to put down these pipes that last 20 years, it starts to make a little bit of sense. And I have a friend, anecdotally, who sells cable to these people, right? They make coaxial fiber optic cable. And he was trying to bid for Liberty's business. And we were having lunch and he said, you know, like we're bidding for Liberty. And I was like, yeah, what do you know about them? And he said that they can't pass engineering because the specs on the cable for Liberty is so high that they just can't pass them. So what that tells me is that the cables that they're putting in the ground are gonna last, right? It's a good quality cable. They are starting to divest. So like a lot of the acquisitions that they started to make are actually going into divestiture at like 6 times what they bought them for. You know, they are really returning cash now. And I think what's happened, the stock is down. Again, it's kind of hard to see. This is the EV to EBIT. The EBIT's kind of standard. Debt to assets is sort of flat. So it's always high, but they're accumulating assets with the debt. So debt to equity is really high, but debt to assets has been constant. And what's interesting that I really like is a 23% free cash flow yield. I mean, they literally print cash, just print cash. And they're about to sell their second largest operation. If it goes through, I don't know how the European Commission is going to be, but they're selling their German and Hungarian operations, I think, to Vodafone. If they do, they're going to get $13 billion in cash. Net of debt, $13 billion. And they're pretty much said that if the stock price stays where it is, they're just going to buy back $13 billion worth of the stock. The stock price is not doing so well, you know. It's not doing terrible, but it's hanging in there. It's middling. That is my sort of outside idea, outside of the quant realm, and like the kind of places that I find that I have to go through nowadays with, let's call it a pervasive overvaluation in the market. But with that, I'm gonna leave you guys. Thank you for listening. And hopefully we can come up with some good questions.
Great, thank you.
I've got 2 questions from Mike. Is your factor strategy, would you call it synonymous with smart beta? And if not, how would you differentiate it? And then regarding your value momentum, is that simply the combination of value and momentum, or is it the momentum of value?
First question, yes, I would say it's synonymous with smart beta. I think it's a little bit semantics out there nowadays, and there is some debate how people want to use the terms, and it seems like smart beta is won out a little bit. But for those who aren't familiar, generally we say smart beta, we're talking about a long-only strategy that tilts towards these factors. Generally in our construction, it's what we do. In terms of the second question, combining value and momentum, yeah, we're basically ranking stocks on each metric. We're taking an average rank, and then the most favorable stocks based on that combination, we're either putting in the portfolio for the pure quant models, or that's at the top of our list when we go through and do our discretionary analysis.
Thank you.
Steve?
Guys, based upon the work that you do, I'm just sort of curious, you guys consider time, T-I-M-E, a diversification tool, or do you consider it to be a factor, an embedded factor? That is, add more time, get better results.
I mean, I think if you're gonna go and do strict factor analysis, like strict factor holding, I think time is definitely, like, you have to hold them through time. I think it's like whether it's a diversification or a factor itself, I don't know. I like to hold for a long period of time. I mean, I think time is like the single source of arbitrage that I can have that maybe other people can't. I mean, like what I found is the results from these kind of strategies pay off in very short periods of time after long periods of time of not working. So I don't know, I guess that doesn't really answer the question, but when it comes to time, that's the way I think about it.
Yeah, I think with time, I mean, I pretty much agree with what Pablo said. I almost put a quote on one of my slides saying, I think there's a quote out there people say, like, it's not timing the market, it's time in the market. Well, I was going to give like a variation of that and say, you know, it's not necessarily just time in the market, it's time being exposed to these factors that have been rewarded. Essentially, I'm saying the same thing, but I'm just saying there are multiple sources of returns. And as far as like the holding period, I think I illustrated that, yes, you know, you kind of need a long time horizon for these things to really play out and give them a chance. And you know, I don't know if your question was alluding to factor timing at all.
You don't see anybody really. I've been sort of away from the business for a few years, but nobody really breaks out time as a factor, and I think time is very much a factor.
I guess my question would be to you, you know, how do you define it, you know, as your factor? What's like, could you actually put it as a column in a spreadsheet? Or, you know, one thing I thought about, you know, because I used to be a trader, and we think over different time frames. We look at the same asset price over different time frames, right? And certain trading strategies can have different holding periods. And I've hypothesized at times that, well, it makes sense to diversify across strategies that maybe have different holding periods. For example, one thing that we always used to complain about was when volatility dropped off. It was boring to trade, honestly, to sit there during the day and it seemed like nothing was moving. But there were still strategies maybe where you were holding over a longer time period that did work during those low volatility times. So in that sense, like the high volatility, shorter time frame strategies may actually blend very well with the longer time frame strategies. And in terms of factor timing, if you were alluding to that, I think the results there are kind of mixed, similar to you know what you would say with the market. One thing, if you do go and try and do research on factor timing, just be aware sometimes there's this tendency to want to use the same metrics that you would use for the market. So like a popular measure for the market is the CAPE ratio, right? And you'll look at the CAPE ratio relative to its history and say, okay, there seems to be a linear relationship between the valuation based on CAPE and future 10-year returns. That was Shiller's big thing. Two things with that. One is that doesn't necessarily mean it's a good timing tool. And I think, you know, most people hear us, you know, you hear it all the time, value is not a great timing tool, simply because if you're looking back, right, like going into, you know, the 1980s, right, and it looked like valuations started to get expensive. At that point, valuations were more expensive than they had ever been in the past, right? But you can't go back in 2018 and you don't have perfect look-ahead bias. We got a lot more expensive. So in that sense, value wasn't a great timing metric. And in essence, if you stay out of the market, it's a trade-off, right? You're either you know, not involved because the market's too expensive, or you risk potentially missing out on that risk premium that you get in the market. Because essentially, price doesn't necessarily have to correct. Earnings could catch up too. And that's one thing that I think they found in market timing strategies. But with factor timing strategies, the problem might be even a little bit worse if you're trying to use value to time factors, depending on the factor. So with momentum and low volatility, as Pablo mentioned, some of these things, the factor composition changes rather quickly. So if you're going to use a value spread on the momentum factor and say, okay, well, value is cheap for momentum, well, that portfolio could be completely different, you know, in a year. So value is not really a relevant metric for a factor like that. For something like the value factor, it might make sense, right, to say, okay, when the cheap stocks are a lot cheaper than the expensive stocks, it might be a good time to be tilted to value. The problem that you actually run into there is you start to, if you tilt to the value factor more than you already have exposure to, you start to lose the diversification benefits. So yes, you might be able to, some of the research I've seen is if you apply factor timing on an individual factor using value, you can marginally improve the performance. But when you look at it in a multi-factor framework, all you're really doing is adding more value exposure to your portfolio, which might not be desired because you want a good mix, a better diversified mix. So I don't know if you were going there with the question, but I thought it maybe was an interesting time to bring the topic up.
Just mostly curious as to your opinion. Sure.
I have a question for Pablo. Can you talk a little bit more about your hedging strategies for equities? Do you do it through options or do you use other instruments?
Yeah, index options. and we try to select for like vega convexity. So essentially, the options will respond very highly to big changes in vol, right? They tend to be further away in time and further out of the money. They're like not prototypical tail hedges, but they're close, right? We've tried shorter term tail hedges and rolling them. It gets messy, they're liquid, you know. So it's almost like prototypical tail hedging. What we're finding out is, like I said, there's some sort of barrier, like the short volatility trade is very strong in the market still. But I think that it's going to continue to be so. And like I said, there was an interview the other day that corroborated it. It felt that way, that there's a barrier somewhere where vol will show up again. I mean, it's amazing. December 2018 should have had the VIX at 40, should have had outside variance swaps much higher, and nothing happened because people were selling vol into that downdraft like crazy. The options I use are not linear, right? So in the beginning, that vol going from 15 to 20 and the market going down 20%, it's not going to move that much. They're going to go up. You know, they'll go up 2-3 times. But if vol goes up to 40 or 50 and the market goes down 25%, they'll go up 20 times or 30 times, you know? So you get a lot of convexity on that last bit of volatility move. So like I said, I wouldn't call it a prototypical tail hedge in like the universal or Taleb type situation, but it's a similar strategy. We've looked at using specific products and stuff, but index options also have this benefit of taxation, but they're 60/40s. So, you know, last thing you want is you get a bunch of cash to buy stuff and then you got to give up 50% of it for taxes, you know. But it's, you know, they worked pretty well in February, and then February was also a weird volatility event because tail hedges worked fantastically for 3 hours after the close on that day, and then the next morning, everybody sold vol again and just calmed the markets back to nothing. It was insane, both of those days. So there's something going on in the vol structure. I can't put my finger on it. I'm not in the market enough. You know, I don't have a big over-the-counter desk, so I don't know. But at today's prices and what the conditions are in the market and everything, I think, you know, volatility is underpriced, and like I'll turn it up or turn it down, you know, depending, but I always have a latent sort of position in it, you know. I don't know if that'll answer the question or not, but yeah.
So question for each of you. Pablo, you mentioned that you screen out utility stocks. I was wondering why. And then one of my observations in the industry is that sell-side equity research analysts get paid for interactions, and it's a lot easier to pitch an exciting stock as opposed to a boring, low volatility stock, low beta stock. So to what extent do you feel like our industry dynamics play into the fact that low beta outperforms high beta? To me, that seems like the most interesting factor, because not only does it perform best over time, it performs best when you need it to in down markets.
I'll just go first. The reason like I screen out those things is because they have different accounting standards. So a lot of the data fetch gets super messy if you put REITs and ADRs and all these things in there. So I just skip them. And plus, I think since they're regulated, all those are much more macro plays, right? You got to get an opinion on interest rates more than on anything else. Same thing with financials. Financials is more a bet on growth and interest rates than an actual security selection aspect. Same thing with REITs. But mostly it's because you can't get there's a lot of accounting data that goes in there and it needs to be standardized, and the only reason is that they don't fit it, and I don't want to crash the screen every time.
As far as the question you had for me, it sounded like for one of the questions you were alluding to, maybe why additional rationale for why make some of these factors work. And I would agree with you. I'd say yes, one, on the low volatility, but also on the value factor. I think that's kind of like, you know, if they're trying to pitch these really exciting glamour stocks, I believe that's the terminology I used on the slide. Yeah, certainly. They're exciting, you know, for individuals to get pitched. Like, you don't want to hear about a stock that's maybe down and out or it's cheap. You know, it might not have an exciting business. I mean, that was Buffett's whole thing. Buy a simple business he can understand at a good price. So absolutely do I think that that's the reason why those things work, and it could maybe also contribute to the low volatility effect, and that those lower volatility stocks just aren't exciting. And I agree. I think that relates to the lottery ticket effect, right? As people want to buy stocks that have a chance to make them rich. I was at a foot doctor one time, and very talkative foot doctor. And she found out that, you know, I worked for an investment advisor, or maybe I was still trading at the time. I don't know. But she asked me if I thought, you know, she should buy Apple. And I was like, well, truthfully, if you ever talk to me, I don't have strong opinions on individual stocks, which, you know, makes sense that I'm more quant in nature. But she said, well, her financial advisor told her just to, you know, I guess for her son, to put all his money in Apple, because you're not going to get rich buying a diversified portfolio. So at least if you buy Apple, you can get rich. And this was when Apple was pretty vertical, if you looked at the chart. And I was like, well, I don't really know. But I didn't want to offend the doctor, so I just kind of stayed quiet. I kind of hinted at like maybe diversification was better. But yeah, people love those stocks that could maybe give them a huge payout and they can retire early. So absolutely.
You come back to something that was on one of your early charts and it wasn't followed up on too much, but I consider critical, and that was the human factor. And of course, you just hit on what are the biases and beliefs, what's in the markets, what are our cultural values that are blindfolding us to opportunities. As I've taught investing, I've always taught that there are always opportunities, even in the times that were supposed to have been awful, like the 70s, which is when I started my career. And one of the stocks I identified at that time was WD-40. And I noticed it was on the top of one of Pablo's screens. And most of you, at least the men, probably know what WD-40 is. It's a little spray can of lubricant. It is like magic if you do stuff around the house or cars or any type of mechanics. And it's still there, and it's still an independent company. I had identified it, loved the product, but I considered it too trivial to invest in at that time. So I didn't. It's a factor of whatever 20 or 40 times. So again, the various human factors you get into. But the one thing that is always in short supply in our society, and in investing especially, is patience. Everybody wants to get rich quickly. They've got people to come to this continent to get rich quickly. And they kept getting them to come here for that reason. And it's built into the value system and into the operation of things. In the 70s, I decided, and I came from behavioral sciences, and I was not interested in getting rich just for the sake of getting rich. But my conclusion was it was very easy to get rich if you had patience and were willing to let time compounding work for you, and use a value approach and use the knowledge that you would come across. Whether it was companies that were right in front of us, Office Depot didn't last that long, but Home Depot essentially started here and is still going. And McDonald's was one of the first growth companies that came public. The year I graduated from college, at that time the #1 stock was General Motors, and it's never seen that price since. If you bought McDonald's on the offering in 1965, you know, it's up several thousand%. I've only owned it for about 20 years. It's up quite significantly, about 8 times plus dividends. So there's always opportunities out there, even the worst, apparently worst times. And it may be best when people are pessimistic. The media, of course, is always overdoing things. One of the things I learned was content analysis in my psychology and sociology studies. What are they really focusing on? And of course, we know it's about the negative things and the startling things, and you know, the things like aliens. And that, unfortunately, is what people look for in the stock market. Not least of all doctors, not just your experience, but mine. Management compliance is challenging.
Dick.
Sometimes you get lucky, and I have one. And, the other thing I'd like to recognize is age. And the first CFA I ran into was at Merrill Lynch in 1979. It was a middle-aged gentleman who had a CFA charter, come from the trust department at, I think, First Wisconsin. And they'd come to Fort Lauderdale and worked at Merrill Lynch. And I happened to have my first office right next door to Merrill Lynch, so I could use all their research facilities and their old funds and pick up on things. And it was Dick Turner over there, who I'm very happy to say I've convinced to get active in the society over the last 5 to 10 years. And Dick, I think, is hitting 92 this year. He rarely misses a meeting.
Years.
What's your CFA number?
Years.
What's your CFA number?
CFA number 69 to 19.
I think it was 1969 when he took
69 to 19.
And when he retired from the industry, he gave me all of his CFA books. You know, he used to get these books that they sent out to you if you were a member. And I love books, and he had picked up on that. So I have a collection of not just the books from when I got my charter in 1991, but from 1969 on, thanks to Dick. And he's been following me around, or vice versa, because he lives right down the street from here, and he applauds this location. But he comes up to Palm Beach or wherever we are to attend events. And I have to think it's not because of my charm, but because of the quality and the diversity and interest members that we have.
It's funny you mentioned patience. I actually almost put a quote on my slide, another Warren Buffett quote, that you can't make a baby in 1 month by getting 9 women pregnant. So, fortunately, I didn't put it on there, but I appreciate you bringing up the topic, because there's a good chance for me to...
Great quotes, but you needed more of those. Even a cartoon or two. And, I'm pleased that we have 2 people in their mid-30s who are so serious and doing studies and out there and doing it right. And hopefully are the type of people that are the future. The millennials will be better than the baby boomers, I think, in terms of their ultimate effects. They're not into instant gratification quite as much. So there is hope for our society.
I didn't think we had.
The only question I had is when it comes to factor decay, position sizes. It looks like you had 50. Is there a number of positions that you put in your portfolio?
It depends on the portfolio. If you're getting to like capacity constraints, there's actually been some good work out there. What's interesting, it's really a function of 2 things. It can be a function of your trading process, right? You know, it pays to trade patiently if you can. Maybe if you have better execution algorithms. But the other thing that can be done is in the portfolio construction process. So like while you're ranking your factors, right? Ideally you want to get the best ranked stocks. But there's a trade-off there, right? The best ranked stocks might not be the most liquid stocks. So alongside, you can actually develop a framework that maybe sort of explicitly deals with that trade-off. It's sort of optimize, okay, can I substitute this momentum stock for something else? And you can do the same thing with taxes too, to optimize taxes. Because that's a question that comes up, is how much capacity is there out there? And some of the research I said is that more than you actually think, but unfortunately I can't put a number. And as far as the number of positions in our strategy, we do have some more concentrated strategies with 20 to 35 names. Those tend to be the ones where we do the additional analysis. And there's others that have 100, 120 names in there.
Yeah, we use, we run pretty concentrated portfolios of about 30 names. We know everything, and positions, obviously, like the standard, will hold them forever. That's not really true, but, it's like I said, like the kind of positions we've been taking, maybe it's the way the market works, but they essentially go nowhere, and then they get caught up in something, and it all happens at once. So just patiently waiting for that to happen, and for the most part, just keep them unless news changes. So we don't really, like I said, we don't really use like factor construction for the allocations. It's more shopping list type construction of the factors, knowing what positions you are, what factors they could be sitting in, how weighted they could be in those factors.
So Pablo gave us a stock pick for the 4th of July. The symbol is LYBTA, I believe.
Yeah, you can.
Liberty A.
Yeah, there's Liberty A and Liberty K. Liberty A has slightly more voting rights, trades at a little bit of a premium. We'd probably just use Liberty K instead, because nobody's going to wrestle control from John Malone and his people. So, I mean, the premium is small.
When I did my CFA preparation, the studies at that time showed that different classes of stock, the one with voting rights had a 7% premium in the markets over time overall to the non-voting.
Full disclosure, it wasn't actually an investment idea. Everybody do your own research. You know what I'm saying? It wasn't a pick. It's just a random stock that I found somewhere.
There's this compliance person talking right there.
Yeah.
Right on the shoulder.
So Mike, what's your stock pick or your ETF fund?
I don't know. I'm not the guy to give stock picks or long run forecasts. If I come up with one in the next minute or so, I'll let you know.
Anything trading at net cash right now?
Are you asking me or just saying it?
Anything trading at net cash per share in this market?
Pablo?
I haven't come across anything, but
How about net working capital?
I haven't like really screened for it. Equity Commonwealth. Yeah. Yeah, talk about another random company. Not a stock selection, but it could be something interesting to look at. We don't hold it. Are they net cash? No.
Well, liquidation, if you look at.
If you sell the bid
what
lettings,
those
right?
Buildings are probably worth.
Yeah, you're
plus
close.
tax.
You're close. Yeah. Sam Zell's a genius.
All right.
Thank you, Bob.